Hey everyone, this is Andrew from Dividend Growth Masters. So the topic I want to talk about today is 5 important financial ratios that dividend investors should be using to analyze dividend stocks. Now, one of the basic skills needed to succeed as a dividend investor is the ability to analyze financial statements. A lot of people think you need to have some kind of advanced math degree to be a successful investor, but that's not true at all. All you need to do is be able to pass 5th grade math, and you're good to go. Alright, so let's talk about our first ratio, which is gross margin. I remember when I first learned about gross margin in my first accounting class in college. I thought it was just another formula to memorize for the test. However, I wish my professor stressed just how important gross margin really is. These days, gross margin is one of the first things I look at when I evaluate a business. Here is the formula for gross margin. Gross margin is revenue less cost of goods sold, expressed as a percentage of revenue. Why is gross margin important? Well, because it tells investors how much it costs a business to deliver a product or service to a customer. For instance, a gross margin of 60% means that the business will earn 60 cents of gross profit for every dollar of sales. Businesses with higher gross margins have some kind of competitive advantage that allows them to earn more profits relative to peers. Now, when you're evaluating gross margin, there are a few things that you need to be aware of. The first thing is, companies in different industries will inherently have different margin profiles. For instance, software businesses typically have very high gross margins in the 70% plus range. In contrast, retailers or restaurants have much lower gross margins, typically around 60% or lower. Secondly, not all companies define gross margin the same way. For example, in the retail industry, some companies include depreciation of store assets in cost of goods sold, while others put it in general and administrative expenses. So you have to be aware of how companies are defining gross margin in their financial statements. The second metric is actually 2 ratios that we should be aware of. The first is dividend yield. Dividend yield is one of the most important metrics for a dividend investor. Dividend yield is just the sum of the dividends divided by the stock price. This ratio is important because it tells the investor what the stock yields, in other words, what it pays out as dividends at the current stock price. Many dividend growth investors are very focused on dividend yield. However, we also must not lose sight of the fact that dividends can be cut or reduced. As a result, we should always be careful of stocks that have a very high dividend yield. Sometimes a company's stock price has fallen significantly due to bad results or a big customer loss or some kind of event. However, it just hasn't cut its dividend yet. Let's say there's a stock that currently pays an 8% dividend and its share price declined from $200 to $100 due to fears about cash flow and liquidity. Now in this case, the stock yields 8%. It sounds like a good investment, right? Well, not so fast. It's likely one of these situations where the stock price has declined significantly and the dividend still has to, quote-unquote, catch up. High dividend yields are not always sustainable. To evaluate dividend sustainability, we want to use the dividend payout ratio. It's calculated as dividends paid divided by net income. This metric tells investors how much profits the company paid out to shareholders as dividends. For instance, a dividend payout ratio of 40% means the business is paying out 40% of profits to shareholders as dividends. Typically, we want to avoid businesses that have a very high dividend payout ratio. This is because when profits fall, the dividend may not be sustainable. Now, here's one thing to keep in mind when using the dividend payout ratio. Sometimes companies record charge-offs of assets, and there may be a large one-time non-cash item that impacts earnings. As a result, this may cause the dividend payout ratio to look higher than it actually is. In these circumstances, it may be appropriate to compare the dividend to the cash flow instead of earnings. The next metric that we'll look at is return on equity. Now, it took me a while to actually understand what equity is. There are a lot of complex definitions, but this is what it really boils down to. Equity represents the cash shareholders have invested into the business and any profits that have been reinvested into the business that have not been paid out as dividends. Now, return on equity is calculated as net income divided by equity. Return on equity measures the profit, measures the return the company earns from the amount shareholders have invested in the business. As dividend investors, we want to buy stocks that generate very high return on equity, ROE. This is because they're efficient in generating returns based on what shareholders have invested into the business. In fact, return on equity is one of the preferred metrics used by Warren Buffett to pick stocks. He has been quoted to saying, "Focus on return on equity, not earnings per share." Now, here's one thing you need to keep in mind when you're using return on equity. Many companies repurchase shares constantly. It's actually a good thing because remaining shareholders will own a bigger slice of the company. However, for companies that do very big share purchases, it can make return on equity seem higher than it actually is. This is because for accounting purposes, stock purchases reduce equity, which is the denominator in the return on equity equation. Stock buybacks will increase the return on equity. So keep this in mind if you find a stock that borrows money to buy back a ton of shares. And this has actually been a common strategy over the last few years because interest rates have been so low. Another important metric is debt to equity. When I first started investing, I actually didn't pay too much attention to leverage as much as I should have. One of the companies I invested in actually nearly went bankrupt because I had too much debt. And that taught me a valuable lesson in leverage. Now, one of the first things I check on the balance sheet is the amount of debt. Here's the formula that I use. It's called the debt to equity ratio, and it's simply calculated as debt divided by equity. This measures how much of the business is funded by debt versus equity. Never invest in a business that is over-levered with debt. Now keep in mind, some businesses will inherently have higher leverage than others, just as a function of the industry. For example, casinos, real estate businesses, and certain manufacturing companies will have higher amounts of debt relative to other companies. This is because they must finance big purchases of big, expensive assets over multiple decades. As a result, try to focus leverage analysis to companies of the same industries. Now, the final ratio that we'll go over is the price to earnings ratio, also known as the PE ratio. Valuation is always important with buying stocks. After all, we want to get a good deal for our money. The price to earnings ratio is one of the most widely used valuation metrics. It's calculated as the stock price divided by earnings per share. The price to earnings ratio measures how much investors are paying for a business relative to the profits it generates. For example, a PE ratio of 15 means investors are paying $15 for every dollar of profit the stock generates. As dividend investors, we always want to get a good deal or at least a fair value on valuation. However, don't focus too much on buying stocks at a significant discount. More often than not, very cheap stocks that are trading for a 30+% discount relative to peers or some industry benchmark are cheap for a reason. They're just not good businesses. Alright, that's the end of the video. Thanks for watching, everyone. If you liked it, definitely hit subscribe, and if you have any comments, let me know below. I'm also going to include a link to my website and my online courses If you're interested in making passive income online or generating dividend income by investing in dividend stocks, I would definitely check those out. Have a great day, everyone. I'll see you next time.